it's Simon Zutshi here, and in this video I'm going to be explaining how much you should be making from your property investments and also looking at how many properties do you need to reach financial independence. Now obviously this will depend on what you want to get to, it depends on what your goal is, and you do need to be clear on what your property goal is, and also it depends on what kind of properties you're going to be acquiring. However, I want to give you some general guidelines that are going to help you become a more successful investor, particularly in the current market conditions where many people are worried about a property market crash because there are so many landlords are selling up. Why are they doing that? Is it really a good time to get in? Well, yes, I believe it is, especially when you look at the kind of returns that buy-to-let property and investment properties can make for you. So let's give you some general guidelines first of all. Now, in terms of replacing your income, we need to be looking at the cash flow that's generated from a property. And if you have a single let property, a typical buy-to-let property might be a house or a flat that you're renting to a couple or a family or an individual. You know, most buy-to-let properties around the UK, you might only get a couple of £100 per month in profit. So you might need quite a few of those to replace your income. Compare that to a property strategy such as HMOs, houses of multiple occupation, or serviced accommodation, where each unit should make you at least £1,000 profit. You might only need a handful of properties to completely replace your income. And a lot of people focus purely on the cash flow generated from their buy-to-let property. However, there's another factor you also need to consider when deciding what investment you should be making. So we need to look at the return on investment. Now, return on investment is a measure of how quickly do you get money back when you make an investment. So for example, if you had a 10% return on investment, the way it's calculated, you look at the annual profit. So it's the profit you make each year after all the expenses, after paying the mortgage, the insurance, the management fees, what's actually left over for you before tax. And then we put the annual profit over the initial investment required to obtain that property. So that's going to be your deposit, your stamp duty, legal costs, those kind of things. And I'm assuming for the moment, to keep it simple, you don't need to do much work to the property. So it's not one where you're doing a big refurb. So you can take it on, a lick of paint, and it's ready to go. So we look at the annual profit divided by the initial investment, and then the answer to that equation we multiply by 100, and that gives us a percentage, and that figure is the return on investment. So let's say you had a profit of £3,600 a year from a single let property giving you £200 profit a month. Okay, so making £3,600 as a profit, you divide it by the initial investment, and let's say that was maybe, I don't know, £36,000. So you got 3,600 divided by 36,000. The answer is 0.1 multiplied by 100 gives you 10%. So a 10% return on investment is actually very good for a single let property. Typically around the UK, you might get between 5 and 7% return on investment on a single let buy-to-let property. If you're in London, that might only be 2 or 3%. Now compare that with something like an HMO, a house of multiple occupation, where you're making much more cash flow, so you make much more monthly and annual profit. So you have a bigger figure on the top of your sum. So let's say you've got an HMO or a serviced accommodation unit that is making you £1,000 profit per month. That would be £12,000 profit a year. And let's say that investment is a bit of a bigger property, costs you a bit more money. Let's say it costs you £60,000 to acquire that property. So you divide 12,000 by 60,000, the answer is 0.2, multiplied by 100 gives you a 20% return on investment. So for an HMO, really you should be looking for about a 20% return. So this is why HMOs are so popular. Not only do you make more cash flow, you're getting a better return. Now what that means is that single let property that might give you maybe a 5% return, it means it's going to take 20 years to get all of your money back. Whereas an HMO that gives you a 20% return on investment only takes 5 years to get all of your money back. Now, obviously, cash flow is not the only way we make money from property. If we hold it long term, we also benefit from the long-term capital growth. And the reason why England and the UK is such a popular place to invest is we have an increasing population and we don't have enough accommodation. So this means over the long term, both rents and property values go up. Now, prices don't always go up. Obviously, we see prices falling in 2023, and this is why many people think we're going to have this housing market crash this year, or maybe a property market crash in 2024. Who knows? I don't think that's going to happen, but we're certainly seeing prices correct from the boom we had during the COVID period. But having said that, we just don't have enough accommodation. What this means is values and rents are going to go up. So where you make the real money is holding property. Now let's look at another number, looking at return on investment. We've looked at the annual return on investment a property can make. Let's say we buy a property that's a £200,000 property, and let's say we've had to put £50,000 into that as our 25% deposit. There are other costs as well, but I'm just simplifying it to explain the maths to you. So let's say we put £50,000 into a £200,000 investment. Now let's say in 10 years time that property doubles in value. Just to be clear, property prices don't all double in 10 years. It's very much an average, depends where you are, what kind of property and when you got into the market. But certainly over a 60-year period, if you go onto Land Registry and do the work yourself, you'll see on average property prices double every 10 years. So if a property goes from 200 up to £400,000, that's a £200,000 increase in the value. Now, if you look at how much you put into that property, you put 50,000 in. Now, if we look at the return on investment in terms of the capital growth, you've got a £200,000 profit sits on top of an initial £50,000 investment. So over that 10 years, you've actually had a 400% return on investment. This is why investing in property is one of the best investments you can make. Now, does it take time and effort to acquire your property? Yes, of course it does. But the time and effort you put in will be the best rewarded work you've ever been paid for, not only on a monthly basis, but also from the long-term capital growth. One of my biggest regrets from property investing is not realizing that and not focusing enough on my property investing. I was just interested. I was making a hobby. I was making money part-time from property. I wasn't really committed. And if you want to be really successful, I suggest you move from interested in property to committed in property. Make it a must. Make sure you're doing the things you need to do to get you to your property goals as quickly as you possibly can. Now, one of the ways you can do that is increase the cash flow and increase the return in investment you're making. So if you do bigger property deals, what I would call mega deals, they're very powerful because you might get from one property, might be a bigger HMO with 10 plus rooms, you might be making £3,000 to £5,000 profit per month. Imagine if you're making that much, £3,000 to £5,000 profit per month. That's from one deal. That's what we call a life-changing deal. For most people, one deal would be enough to replace their income. Now, let's be realistic. If you don't have any properties just yet, your first deal is probably not going to be a mega deal and probably shouldn't be a mega deal. But if you do already have investment properties, when you know how, there's no reason why your next deal should not be a mega deal. So we can increase the cash flow, the profit we make by doing bigger deals. And guess what? There's not as much competition looking for the bigger deals because most people think they can't afford to buy them. The reality is a bigger deal is going to need more money to put in. But when you have such a strong cash flow coming out of that property deal, it doesn't have to be your money to acquire the property. There are also other strategies you can use where you can make cash flow from property that you don't actually own. Obviously, the first one of those is rent to rent, where you take on a property that someone else doesn't really want, you manage it, and you pay the owner a guaranteed rental income that's less than you could rent it out for, so you make a profit on the margin, less any costs. Now, if you're doing a rent-to-rent deal, they're typically 3 to 5 years, then you give the property back to the owner. So I reckon you should get a 100% return on investment, otherwise it's not a good enough deal. What that means is any money you have to put in to get the deal going, get it set up, your legal paperwork, etc., you want to make sure you get that back in rental profit within the first year. That's why it's 100% return on investment. Otherwise, it's not worth doing. Another strategy you can use, which is better than rent to rent, is purchase lease options. It's similar to rent. You take on a property, you manage it, you pay a fixed rent to the owner, but you also have the right to buy that property in the future. You set a price today, you've got a right to buy it in the future, And what that means is, as well as getting the monthly cash flow, you can actually benefit from capital growth on a property that you don't actually own. Because you agree price now, today's full price maybe, and in 5 years' time, even though the market might dip first and then come back, that property could be worth more in 5 years' time than it is now, and you've agreed to buy at today's price. So today's price, full price, might actually be a discounted price compared to the future value in maybe 5 years' time. Now, with a purchase lease option, we don't need the return on investment to be as good as a rent to rent deal, because we've got the potential capital growth as well. So if I'm doing a purchase lease option, I want to get at least a 50% return on investment. What that means is the profit I make each year, I get half of my initial investment back in the first year, and I get half of it back in the second year. So this is a very good way of controlling property, getting cash flow, and getting potential equity growth. The other thing is, instead of actually buying a property, which can take months and months at the moment with the difficulty getting mortgages, we don't actually get a mortgage when we do a purchase lease option until we actually buy the property in 5 years' time, if indeed we want to buy, because we have the right to buy but not the obligation to buy. So I do hope this video has been useful for you in terms of understanding the different amounts of cash flow you can make from different buy-to-let strategies, and also understanding the return on investment, because it's not just cash flow, it's return on investment we also have to look at as well. So if you like this video, please like it, come and put a comment below. If you haven't subscribed to the YouTube channel, why not hit the subscribe button, hit the bell icon, you'll get notified whenever I bring out a new video. As ever, I encourage you to invest with knowledge, invest with skill. I do hope you got massive value from watching this YouTube video. I'd encourage you to click on the link below to come and do the online training with me. And I've got another video lined up for you, which I think is also going to be really useful, that you should watch once you've registered for the online training with me. So invest with knowledge, invest with skill. I'll see you very soon.